Okay, so we've got a whole stack of articles here,
Yeah.
and they're all about this thing called return stacking. Have you heard of this?
I have, yeah. It's
like a whole new way to think about
a pretty interesting concept.
Yeah.
For sure.
how we build investment portfolios.
Yeah,
You're going to be surprised by how clever some of these strategies are.
definitely.
We've got articles mostly from a company called Return Stacked,
Okay.
and it seems like they're really challenging the traditional
Yeah.
60/40 portfolio model.
You know what's fascinating to me is they're really addressing a growing concern.
Mm-hmm.
That 60/40 approach, that old reliable mix of stocks and bonds,
Right.
might not be as effective as it once was.
You know that old reliable 60/40 portfolio?
Yeah.
Well, these articles suggest it might not be so reliable anymore.
Hmm.
In fact, one article cites data showing that less than 9% of active managers
Wow.
focusing on U.S. large-cap stocks
Oh.
have been beating the market over the past 15 years.
Yeah. That's a significant.
That's a pretty big deal,
Yeah.
considering those stocks make up over half the
Right.
global market.
Over half. Yeah.
And it sounds like you're looking for smarter ways to diversify your investments,
Absolutely.
especially in a world where that classic approach might not be cutting it anymore.
Yeah. You know, it's a paradoxical situation where the majority of your capital is allocated precisely where it's hardest to find alpha.
Hold on, alpha.
Oh, yeah. Sorry.
Refresh my memory on that one. I know I've heard it before, but...
So alpha basically refers to the extra return you get
Okay.
above and beyond what the market delivers.
Gotcha.
So it's a measure of how much value a manager or strategy adds.
So are these articles saying there's not much alpha to be found in those big U.S. stocks anymore?
That's what the data suggests, yeah. And that's where this idea of return stacking comes in.
Okay.
It dives deep into something called portable alpha.
Portable alpha.
Yeah.
That sounds intriguing,
Yeah.
but also a little intimidating. Break it down for me.
Sure.
What is it, and why should I care?
Think of it this way.
Okay.
It's a way to keep the market exposure you want,
Uh-huh.
like staying invested in those U.S. stocks,
Right.
but adding on extra sorts of return that aren't directly tied to them.
Okay.
It's like adding an extra engine
I like that.
to your investment rocket,
Yeah.
but without having to overhaul the whole thing.
Okay, I like that analogy.
Yeah.
An extra engine for my portfolio.
Exactly.
Who wouldn't want that?
Right.
But how exactly do I get this extra boost?
Well, that's where things get really interesting.
Okay, wait on me.
These articles highlight two powerful strategies
Okay.
called trend following and carry.
Wait, hold on.
Yeah.
If I'm understanding this correctly,
Okay.
they're basically suggesting we can add these extra return engines using things like futures contracts.
That's right.
That sounds pretty risky.
It's not as risky as it might sound.
Really?
Remember PIMCO back in the 1980s? They pioneered a strategy called bonds PLLES, which was revolutionary
Okay.
for its time.
Okay.
They used futures contracts to get exposure to treasury bonds.
Uh-huh.
But here's the kicker.
Okay.
They only had to put up a fraction of the capital
Okay.
they would need it if they bought the bonds directly.
So they got the same exposure, but with less money tied up.
Exactly.
That's pretty clever.
Right.
What did they do with all that extra cash they freed up?
Well, they invested it in short-duration bonds,
Okay.
where they felt they had an edge
Okay.
to generate even more returns.
Got it.
This was really the birth of return stacking,
Hmm.
using capital-efficient tools to essentially
Huh.
stack an additional return source on top of
Interesting.
their existing bond exposure.
So it's not just about diversifying
It's more than that.
in the traditional sense of
Right.
spreading your money
Yeah.
across different assets.
It's about adding layers
Okay.
of potential return on top of your core holdings.
And it's not limited to just stocks and bonds.
Not at all.
You can apply these principles to a wide range of asset classes,
Absolutely.
including real estate commodities and even private equity.
That's right.
That's really interesting.
Yeah.
I've never thought about diversification in quite this way.
Yeah.
But let's go back to those two strategies you mentioned,
Sure.
trend following and carry.
Yeah,
The articles suggest they work really well together,
they do.
but I'm still a little fuzzy on how they actually work.
Okay.
Can you unpack that a bit more?
Absolutely. So trend following tries to capture profits by riding the wave of market momentum,
Okay.
not just individual stocks, but across various asset classes like
Yeah.
stocks, bonds, currencies, and even commodities.
Wow. Okay.
Imagine surfing a big wave.
Okay.
Trend following is about
Yeah,
catching that wave and riding it as long as it lasts.
Gotcha.
So Carry, on the other hand,
Okay.
is a bit like collecting rent. It focuses on exploiting yield differences between assets, like the difference between borrowing at a low interest rate and lending at a higher one.
So it's kind of like profiting from the spread between those rates.
Exactly.
Okay.
And this strategy has been a favorite among commodity trading advisor funds, or CTAs, for a long time.
I've heard of those.
Yeah.
So both of these strategies, trend following and carry, are about capitalizing on market movements, just in different ways.
Yeah, they have different approaches.
One is about riding the waves of momentum.
That's right.
And the other is about collecting that steady rent from yield differences.
Precisely.
Okay.
And the key here is they both heavily utilize futures contracts, which are incredibly capital-efficient tools.
Right, like PMCO did.
Just like PIMCO did with their bonds plus strategy.
Exactly.
Yeah.
Okay, I'm starting to see the appeal here.
Yeah.
But is that how people are doing it now? I mean, PMCO was doing this back in the 80s.
The core principles are the same.
Right.
But the tools and strategies have definitely evolved.
So how has it changed?
Today, return stacking uses a variety of capital-efficient tools.
Okay.
Not just futures, but also options, swaps, and other derivatives.
Wow. Okay.
It's about finding creative ways to gain the desired market exposure while freeing up cash to invest in those alternative strategies.
Gotcha.
With the potential for higher returns.
Can you give me a concrete example? Something I can really wrap my head around?
Absolutely. Imagine you're an institutional investor.
Okay.
Like a pension fund.
Yeah.
And you want to invest $100 million in the S&P 500.
Okay. $100 million.
You could do that the traditional way.
Okay.
By buying a bunch of shares in an S&P 500 ETF.
Right.
Which would cost you the full $100 million.
Okay. That's the straightforward approach.
But you could also achieve the same exposure.
Okay.
By using S&P 500 E-mini futures contracts. Now, instead of needing the whole $100 million,
right,
you'd only need to put up a small fraction of that.
Okay.
Maybe around $5 million as margin.
Whoa, that's a huge difference.
Right.
So with the remaining $95 million...
you could then invest it in other strategies that you believe can generate higher returns.
Oh, wow.
Effectively layering those returns on top of your S&P 500 exposure.
Because you're getting...
That's the magic of return stacking.
Yeah.
It's like having your cake and eating it too.
You get to stay invested in your core holdings.
Yeah.
But you also get to tap into these additional return sources.
Exactly.
It's like adding sprinkles to your ice cream sundae.
I love that analogy.
You still get to enjoy the main flavors, but with an extra bit of sweetness on top.
That's a great way to put it.
And that's a key advantage of return stacking.
Yeah.
It's not about replacing one thing with another.
Right.
It's about enhancing what you already have.
Exactly.
Okay, so we've got this idea of adding extra layers of return potential on top of our core investments. But let's dig a little deeper into trend following and carry.
Okay.
These articles suggest they're a bit of a power couple when it comes to return stacking.
They do work well together.
But I'm still a little skeptical.
Okay.
Doesn't using derivatives like futures contracts add a whole new layer of complexity?
Sure, it can.
And potential risk?
Yeah, that's a valid concern.
How do we know these strategies will actually work in practice?
Well, you're right to be cautious.
Yeah.
But the evidence suggests that these strategies, when implemented correctly, can be quite effective.
Okay.
You see, trend following and carry tend to perform differently in various market conditions.
Yeah.
They're like two sides of a coin.
Okay.
Each revealing a different aspect of the market's personality.
So when one is zigging, the other is zagging.
Precisely.
That's how they balance each other out.
That's the idea.
Okay.
Trend following shines during periods of sustained market trends. Whether the market is going up or down, it's about capturing those big swings.
Right.
Carry, on the other hand, tends to do well in calmer, more stable markets where those yield differentials can be exploited. Think of it as profiting from the relative calm between those big market storms.
So by combining them, you're essentially creating a more balanced and stable overall return.
Exactly. It's like having a portfolio that can adapt to different market environments.
Gotcha.
If the market is trending strongly, trend following will likely lead the charge. If things are calm, carry will pick up the slack.
It's like a tag team.
It is, yeah.
That makes a lot of sense.
Good.
But let's talk about the benefits of this whole return stacking approach.
Sure.
Beyond just potential return enhancement.
Yeah.
I mean, is it really just about squeezing out a little extra return?
I think it's more than that. Or is there something more to it?
I think so too.
One of the biggest advantages,
Okay.
and it's something that really stood out to me in these articles, is the impact on investor behavior.
Oh, okay. I'm intrigued.
Yeah.
How does return stacking affect how we behave as investors?
Think about it.
Okay.
With traditional diversification, you're often forced to sell off some of your existing holdings to make room for new assets.
Right.
This can create a lot of anxiety.
It can.
Especially if the asset you sold ends up performing well.
Tell me about it.
It's that dreaded fear of missing out.
Oh, that FOMO can keep you up at night.
It can.
I know it can lead to some bad decisions.
Absolutely.
Yeah.
And that's where return stacking can help.
Okay.
Since you're not selling off your core holdings to add those alternative strategies, you don't have that same feeling of missing out.
Okay.
It's more like adding an extra layer
Right.
of potential return on top of what you already have.
So it takes some of the emotion out of the equation.
I think so.
That's a big plus in my book.
Yeah.
But let's get real for a second.
Okay.
Are there any real-world examples of this actually working?
Absolutely.
I mean, are any big institutions
A lot of them.
actually using these concepts?
In fact, many of the institutions you've likely heard of are already incorporating return stacking concepts
Really?
into their portfolios.
Like who?
Pension funds,
Okay.
like the Ohio Police and Fire Pension Fund,
Okay, yeah.
are known for using portable alpha strategies to enhance their returns.
Okay.
Even large companies like Delta Airlines and Eli Lilly are utilizing these techniques.
Okay, that definitely gives me more confidence.
Yeah.
If these sophisticated institutions are using return stacking, it's probably a good sign that it has some merit.
That's what I think.
But let's not forget about risk.
True.
I remember back in 2008,
Oh, yeah.
I was so stressed about my investments.
2008 was a tough year.
The market was in free fall.
Yeah.
And it seemed like nothing was safe.
Right.
What are some of the risks associated with return stacking?
Well, one of the main risks is the potential for increased volatility.
Yeah.
Especially if you're layering on strategies that are highly correlated with each other.
So it's not just about stacking any random strategy.
It's not just about random stacking.
On top of another.
No, you need to be thoughtful about it.
We need to think about how they work together.
Exactly.
Right? Because if they're all doing the same thing at the same time.
Yeah. You're not really getting the benefit.
Very diversifying.
Of diversification, right?
Makes sense.
Remember how we talked about trend following?
Yeah.
And carry working well together?
Yeah.
Because they tend to perform differently?
Yeah.
In various market conditions?
Right.
That's the kind of synergy you want to aim for when building your return stacks.
So even though we're adding these extra layers, diversification is still key. Don't forget about the importance of due diligence.
Oh, it's crucial.
Just because a fund or ETF claims to be using return stacking concepts doesn't mean it's a guaranteed winner.
No, not at all.
You still need to carefully evaluate their track record, their investment process, and their risk management practices.
That's right.
Okay, so a healthy dose of skepticism is always a good thing.
A good thing, yeah.
Even when dealing with these seemingly sophisticated strategies.
That's right.
What about the costs associated with return stacking?
Costs are always a consideration.
Are these strategies more expensive to implement?
It depends.
Than traditional investments?
Some strategies like managed futures can have higher fees than, say, a simple index fund.
Right.
But remember, you're potentially getting access to more sophisticated strategies that can generate alpha, that extra return above and beyond the market.
Right.
So those higher fees might be justified.
Gotcha.
If the strategy...
Okay, so it's a trade-off.
It's a trade-off.
Between potential returns and costs.
Yeah, just like with any other investment.
Just like with any other investment.
Yeah, you need to weigh those costs against the potential benefits.
But didn't you say earlier that the rise of ETFs and mutual funds has made a lot of these strategies more accessible and cost-effective?
Exactly. That's one of the exciting things about return stacking. It's no longer just a game for the big institutions with the right ETFs and mutual funds. Everyday investors can now access these sophisticated strategies in a cost-effective way.
So where can our listener go to start exploring these ETFs and mutual funds?
There are a lot of great resources available online.
The
Return Stack website, for example, has some informative articles and videos that can be a good starting point. They even have a section dedicated to ETFs and mutual funds that utilize return stacking concepts. And of course, you can always consult with a financial advisor who specializes in these types of strategies.
Finding a knowledgeable advisor who understands your individual needs is always a good idea.
It is.
Especially when dealing with these more complex strategies.
For sure.
Any other parting thoughts for our listener?
Just that return stacking is a powerful tool that has the potential to transform the way we think about portfolio construction. It's not about abandoning traditional investments altogether, but rather about finding creative ways to enhance those investments and potentially boost returns while also managing risk. It's about building a portfolio that's truly customized to your individual needs and goals.
Beautifully said.
Thank you.
I'm ready to take a step back and process all this new information.
There's a lot to unpack.
Before we wrap up, let's go over some of the key takeaways for our listener and explore some practical steps they can take.
Sounds good.
If they're interested in adding a little return stack magic to their own portfolios. Okay, so we've covered a lot of ground here.
We have.
From trend following to carry to merger arbitrage.
Yeah, a lot of interesting strategies.
It seems like return stacking offers a lot of potential benefits, from boosting returns to improving diversification to even aligning your investments with your personal values.
It's a very versatile approach.
But I have to ask, is it all too good to be true?
Well,
what are some of the potential downsides?
You're right to be cautious. Any investment strategy comes with risks. And return stacking is no exception. One of the main risks is the potential for increased volatility. Especially if you're layering on strategies that are highly correlated with each other.
So it's not just about stacking any random strategy on top of another.
Exactly.
We need to think about how they worked together.
You need to consider the interactions between the strategies.
Because if they're all doing the same thing at the same time...
you could end up amplifying your risk.
You're not really diversifying.
Instead of mitigating it.
Makes sense.
Remember how we talked about trend following and carry working well together? Because they tend to perform differently in various market conditions?
They kind of balance each other out.
Exactly. That's the kind of synergy you want to aim for.
Gotcha.
When building your return stacks.
So even though we're adding these extra layers, diversification is still key.
Absolutely. Diversification is always important.
And don't forget about the importance of due diligence.
Oh, that's crucial.
Just because a fund or ETF claims to be using return stacking concepts.
It's not a guarantee.
Doesn't mean it's a guaranteed winner.
You still need to do your homework.
You still need to carefully evaluate their track record.
Look at their investment process.
And their risk management practices.
All those factors matter.
Okay, so a healthy dose of skepticism is always a good thing.
It's essential.
Even when dealing with these seemingly sophisticated strategies.
Absolutely.
What about the costs associated with return stacking?
Costs are always a factor.
Are these strategies more expensive to implement?
It really varies.
Than traditional investments.
Some strategies, like managed futures, can have higher fees than, say, a simple index fund. But remember, you're potentially getting access to more sophisticated strategies that can generate alpha, that extra return above and beyond the market. So those higher fees might be justified if the strategy delivers.
So it's a trade-off.
It always is.
Between potential returns and costs.
Just like with any investment decision.
Just like with any other investment,
You need to weigh those costs against the potential benefits.
But didn't you say earlier that the rise of ETFs and mutual funds?
Oh, yeah, that's been a game changer.
Has made a lot of these strategies more accessible and cost-effective.
Exactly. That's one of the great things about the evolution of the investment landscape. It's no longer just a game for the big institutions.
So everyday investors can benefit from these strategies?
Absolutely, with the right ETFs and mutual funds. Everyday investors can now access these sophisticated strategies in a cost-effective way.
So where can our listener go to start exploring these ETFs and mutual funds?
Well, there are a lot of great resources available online.
Like where?
The Return Stacked website, for example, has some really informative articles and videos. That could be a good starting point. They even have a section dedicated to ETFs and mutual funds that utilize return stacking concepts.
Great.
And of course, you can always consult with a financial advisor who specializes in these types of strategies.
Finding a knowledgeable advisor who understands your individual needs
It's essential.
It was always a good idea.
Especially when dealing with these more complex strategies.
For sure. Any other parting thoughts for our listener before we wrap up this deep dive?
I'd just reiterate that return stacking is a powerful tool.
Yeah.
That has the potential to really change how we think about building portfolios.
It's a whole new way of looking at things.
It's not about abandoning traditional investments altogether.
Right.
It's about finding those creative ways to enhance what you're already doing.
Okay.
To potentially boost returns while also managing risk. It's about building a portfolio that truly reflects your individual needs and goals.
Beautifully said.
Thank you.
So what does this all mean for you, our listener? It means that the world of investing is evolving, and with a little bit of knowledge and effort, you can take advantage of these exciting new strategies. Do your research, consult with a trusted advisor, and never be afraid to challenge the status quo when it comes to building a portfolio that truly reflects your unique financial goals. And on that note, we'll wrap up this deep dive into return stacking. Thanks for joining us on the Deep Dive.